Hey everyone, welcome back to another episode of the Free to Grow CFO podcast, where we dive deep into conversations about scaling a profitable D2C brand. I'm your host, Jon Blair, founder of Free to Grow CFO. We're the go-to outsourced finance and accounting firm for 8 and 9-figure D2C brands. And today, I'm super stoked to have a duo on the show. I think you guys are actually only the second ever duo, Rolando and Raul Lopez. Welcome to the show, guys. What's happening?
Thank you, John.
Thank you for having us on.
Appreciate you having us.
Yeah, man. Okay, so brothers, right? And running CFO Associates. Who wants to jump in and just briefly introduce CFO Associates? What do you guys do?
Yeah, so we're a CFO and tax advisory firm. We have 2 offices, one in Tampa, Florida, one in Puerto Rico. We also know a program down there called Act 60, which is a big tax strategy for people. So, me and Raul, as you mentioned, we're brothers. We were actually born in Havana, Cuba. So, in hindsight, it's a privilege to be a CPA and run a CPA firm with my brother, being in this country. So, we do have that perspective as accountants, that we really do enjoy entrepreneurship overall. And Raul is also big in real estate as well.
Yeah. So Raul, you do a little bit on the broker side of real estate.
Yes. So as Rolando mentioned, we help a lot of clients on the tax planning side, obviously on the controllership and accounting side as well. But I have my broker's license in Florida. And to be honest, we love helping clients. It's easy to digest the P&L and see, hey, you're renting here. Let's make sure we can get you into a building that you own and you can pay yourself rent. So we definitely like to see that and analyze that with all of our clients.
Yeah. So, okay. So, elephant in the room. People are probably going like, wait a second, you're bringing other fractional CFOs onto the show, right? And so let me explain how we know each other and why this is actually going to be a really great conversation. So we actually originally met through a mutual client in which CFO Associates was providing bookkeeping and tax advisory. And we provide to this particular client CFO services. Obviously, as you guys know, with our focus on D2C, we go really deep into specific areas around like marketing and ad spend and some other things. But what I found is I get asked constantly, actually probably more than any other, I think I get asked most frequently for 1, recommendations to ad agencies because of our focus in D2C, and then 2, tax advisory, right? But I always get asked specifically about like a tax advisory firm or a firm that does tax advisory that understands eComm, right? And I've searched high and low and had a lot of challenges with finding said firm, met Raul and Rolando, and we've kind of found this really great, ability to partner on getting people referred over to a tax firm, CFO Associates. I know you guys do other things, but like in part tax advisory, and they have an eComm practice, right? So they work with a lot of eComm brand founders, which is super key. But then we kind of bonded on this second thing, like Raul was mentioning, real estate investing. Something we've talked about on the podcast before is using your business to build wealth without putting all your putting all of your wealth in a potential exit, right? And so what we're going to talk about today is wealth building and tax strategy for eComm brand founders. More specifically, the connection between tax strategy and wealth building strategy.
Absolutely.
Why is this important? Because the less you pay in taxes, the more money you can invest in building wealth faster. So before we dive into this, can you guys just give a brief background on like what your kind of perspective or passion is around wealth building plus tax advisory?
Absolutely. Part of wealth building, tax planning has to be involved, right? And especially once you have a cash flowing business, the most important part is how do you keep the most in your pocket or reinvest it back in the business. The way that we look at a client is based on their assets in their specific business. In this case, D2C clients that we're talking about today. What are the tax codes and areas that you're able to leverage? Now, out there in social media, you see a lot of people, buy this, buy that. Ultimately, what's really important is what are the assets and what are the low-hanging fruit for that specific client that we're looking at. And what we like to do is, on a quarterly basis is, show them, hey, year to date. An example, John, when we work with you, right? We get your P&Ls from you guys. We say, year to date, you're here. This is how much you owe if you do nothing. However, there's these 4 or 5 things that are available to you based on the assets, based on the things that we've discussed and the goals that you have. And so that's how we kind of really customize the tax planning for that specific client, because I tell people this, a lot of times when somebody comes for tax planning, it's not that their CPAs aren't bad. They're just not approaching it in this manner. And they're
Mhm.
only touching base with them once, maybe twice a year when they reach out to them. We, in our planning engagements, we schedule out 4 to 5 calls throughout the year. Whether, we pull you into that, we pull the numbers, we calculate it for you and put it in front of you so you're aware. And that's ultimately what even leads to being able to strategize, right? Because without
Totally.
that, then it makes it very difficult, in hindsight, when everybody comes to
Totally.
tax filing.
It's already done. You're like, man, I wish I knew the tax year's already over. And you're like, if we had talked earlier,
Correct.
right,
Yeah.
what we could
Exactly.
have done, right?
Exactly.
And like, so being proactive is super key. I want to ask Raul, and then maybe I'll ask the same question to Rolando afterwards. But Raul, okay, this is like editorial, your opinion. We're talking about tax efficient investing strategies for eComm brand founders to build wealth. Real estate, stocks, or something else if you had to choose one.
Yeah. Without a doubt, I'm gonna say real estate, a little biased, but we've seen multiple of our clients build wealth this way, but also, for DTC companies in general, if it's possible for you to buy a real estate building in the United States, as everyone has seen this year, there's been a lot of variabilities from tariffs, even cutting lead time, right? If you have your own building in the United States, you don't have to prepay for 3 to 6 months. You can keep that cash flow for ad spend or whatever you need while you're paying yourself rent as well, right? You're already paying rent to someone else if you have a brick and mortar, but if you can pay yourself rent while then creating that wealth and also being able to use depreciation, which is a non-cash expense, to lower your tax bill is definitely the number one way to go, in my opinion, specifically.
And John, because we have access to our clients' P&Ls, like this is a good example of where Raul, a good case study where he identified a P&L like that. And Raul, I'll let you explain it, how that client ended up.
Yeah, absolutely. They were paying rent for literally 10 years. They've been paying rent to somebody else. And I came to them and was like, hey, you guys are paying literally $14,000. You can buy yourself $1 million building, pay less in rent and less of an expense to your business, while also, building wealth by owning an asset that's most likely going to appreciate
For
long
sure.
term. So that's definitely a great case study that we saw.
Well, okay, so I want to highlight something. Here are a lot of I have a lot of brands who've come to me over the years and been like, "Hey, should I go spend my money on this to lower my taxes?" But I want to bring up a key distinction that you made in your example, right? Which is, were you going to spend money on that already? Or are you just looking for something random to spend money
Exactly.
on lowering your taxes?
Exactly.
Those are different things. And unfortunately, there are a lot of tax advisors out there who are like, tell people to go buy things that aren't necessarily good investments. And they're like, it'll lower your taxes. But in my opinion, generally speaking, where it's really advantageous is if you were going to spend that money anyways, but you can structure it in a way that one, builds wealth, two, is tax advantage potentially in another way. And that's a perfect example of swapping out a lease expense for a mortgage payment, right? And amongst other things, like appreciation plus the mortgage pay down, right? You're building
Top
equity,
of that.
whereas you're never building any equity in a lease payment, right?
And you have other options too, right? You can leverage that building if you need to take cash out refi, you don't get taxed on refinances, right? If you need to take that cash and put it into somewhere else, or if you are going to sell your business long term, you could always keep the building and always collect rental
Exactly.
income on a business
Totally.
that you know is cash flowing and is going to be able to pay you rent, right?
Well, so I know a guy, check this out. This is like, he's a family friend. He's kind of badass. He ran this roofing supply distributorship for a long time, for like 12, 13 years. And he opened up locations all around the country. I don't think he necessarily owned the real estate and all those, but he did own the yards where they were like bringing in all the materials and then distribute them. He sold the business for hundreds of millions of dollars, but he did not sell the real
Real
estate.
estate.
And actually
He's
the
still maintains it.
acquirer rents it back from him still to this
That
There
is
day.
you
the
And
go.
so I
position
mean,
to be. That is the best position to be in. Yep.
yeah,
Yep. And it's mailbox money after your cash out, right? It's
exactly.
the best.
Exactly. Well, okay. So there's another thing I want to double click into that you just mentioned about the ability to change the leverage on the real estate asset over time. Because this is, I think, a big thing people missed. That's a distinguishing factor between investing in, say, index funds in the stock market and investing in real estate. This doesn't make one better than the other, but there's a key lever you don't have in investing in the stock market, right? Which is like, and this is kind of the game I'm playing with my personal real estate portfolios. Like I'm buying rental properties that, even though interest rates are high, they've been in like the sevens, right? I'm finding deals that still generate some cash flow, right? But at some point when real estate, when I can refi those at maybe 5.5%, I can pull out a good chunk of change actually. Those will still cash flow. Well, I can do one of two things. I can either refi and just crank up the monthly cash flow, right? Which may get me closer to retiring. Or if I'm still in acquisition mode, right? Or I have other places where I could put that capital if I do a cash out refi, I can get that money out, like you said, tax free, right? That like ability to adjust your leverage over time is a massive, massive wealth building, tool that you don't have with stocks.
Exactly. Exactly. Well, and look, in the example that Raul gave to John, this person had been paying rent, to your point. It was in their P&L.
Totally.
And I say this to people, the easiest way to be a vertical business, if you're paying rent, go buy the real estate you're paying rent in. You're effectively, making the real estate part of that. And on the end, you have that leverage to then say, hey, here's a triple net lease with the building, and then sell the business. And now you're just collecting the rent like your buddy was doing. And we see
Totally.
that as well on our end. And it's a great strategy. And that's why if you're going to make an investment and a leap into real estate, at least you should do it in a property that you can control, that you're operating
Totally.
and your owner running your business out of. You understand it, and that de-risks it a lot too, right, John? Because a lot of people, that is the fear, the fear of a lot of money up front for real estate. Well, then buy your own building. You're paying rent to somebody else,
Totally.
and so
Totally.
that's how we
I
look
want
at
to
that.
ask you, I want to ask you a little bit more about depreciation, right? Because that was another thing. That's another key when I think about the tax efficiency, right, of real estate. Depreciation is definitely a key part in that. Can you just really quickly run through high level how that works and why it's tax advantageous? And then I do want to go after that a little bit deeper into cost seg studies and accelerated depreciation. But how does that work, and why is it tax advantaged?
So I'll talk in the context of commercial because that's what DTC would probably owner would buy, right? So commercial real estate is depreciated over 39 years. Now, that means if you buy a building for $1 million, you don't expense $1 million this year. You take it and less the land, you got to allocate some to land, you divide it by 39 years. Now, currently with the new updates to the tax code, you now have 100% bonus depreciation back all the way to 2029. So instead of depreciating over 39 years, you can do what you were mentioning, John. It's called a cost segregation, which takes that same building and breaks it down to smaller asset components that accelerates the depreciation forward. Now, all of this is a paper expense, right? You're not outlaying any more cash or any less cash. It's all a paper expense. And the beauty about real estate is even if you leverage to buy the property, meaning taking out debt, you still get the same amount of depreciation, right? And that's where the beauty of what I like to call phantom income occurs, because in a scenario that Raul was explaining, that client of ours is now paying rent to herself and her husband's building. And then now that depreciation is offsetting that income, right? So rather than now, paying it to somebody else, they're creating wealth and saving taxes at the same time.
Right. But also, what Rolando is saying is in layman's term is, right, let's say you make $100,000 in your bank account, you have $100,000 from your rental property. On your taxes, though, you get to depreciate for the example. To make it easy on this example, really, let's say your depreciation for that year is $100,000. Well, on your tax return, you netted $100,000. You have $100,000 in your bank account, but on your tax return, you're actually going to show no income that year.
That's the phantom income,
and so
right?
That's the phantom income Rolando's talking about.
And what you were talking about with leverage, I'll explain this another way. Is let's say you're buying $1 million building, but you only put 10% down, so you outlaid $100K. You actually are going to be able to depreciate. Well, you got to back out land, but more than $100K, the full value, right? Even though you use someone else's money to purchase it. And the beauty, let's actually, I want to ask you, Raul, about, let's say someone is an eComm brand founder. They're scaling, they're taking cash out in the form of distributions, and they're buying rental real estate. Like, walk me through the example of how depreciation works with residential real estate. If you're doing buy and hold, and maybe there's positive cash flow, but from a tax perspective, it's even better because of depreciation.
And what I guess for depreciation, you have to understand that it can only be offset other passive income as well, right? Like you can't have a W-2 job and then have that offset. So let's say you have 5 properties and one of them happens to be your DTC company's property. Well, if you're cash flowing a bunch in one property, you can depreciate, you can do bonus depreciation on a different property, and you can offset, basically it all goes into one bucket, right? Is what I'm getting at. So you can offset your other losses with your other rental income with different properties that you may or may not have. But that's a key concept that people need to understand as well. Like you need to make sure that when you're doing this depreciation, it's only offsetting your passive income and not your active income on day-to-day operations for other
Unless you're a real
businesses.
estate professional, which is
That's what I was going to ask
one
you about next.
strategy.
That's what I was going to. So let's talk about that next. So actually, Raul's got a sweet setup. I don't know how your personal tax situation is, but I do know people who run a given business, but they're also a real estate professional, and they're able to meet the qualifications to be what the IRS considers a qualified
Right.
real estate professional.
Right, which
what
is
does that
750.
do?
So that allows you, that completely, ignore exactly what I said just 2 seconds ago. It completely eliminates that, because then, since you are a real estate professional, any sort of real estate activity is now considered active, and it falls into now the same bucket. Same thing with short-term rentals, right? If you have an Airbnb and you rent it out on average of 7 days or less, that's considered active income, and you can use that appreciation against your regular income as well.
So this is not a strategy that's for everybody, right? Because there are certain qualifications. What are the general criteria that must be met to be able to be considered a qualified real estate professional?
You have to spend 750 hours in real estate, and also more than 50% of your time also has to be allocated to real estate activities throughout the year. So those are the two main points that you need to make sure that you follow with your CPA, and make sure that you're tracking this on an annual basis. But those two are the main points that make you a real estate professional in that year. Luckily, I'm a broker, so I do spend that time throughout the year on my personal taxes per se.
Yeah. And also one thing I want to clarify, and I'm glad Raul said that, just because your broker doesn't automatically make you, and vice versa, just because you're not a broker doesn't mean you're not also either, right? So those qualifications are really for everybody, as long as they're spending it in a real estate trade or business throughout the year. Unfortunately, a lot of business owners, to your point, John, have a hard time kind of, splitting away from their day-to-day business. So it makes it difficult. Raul does have that plus. It's funny, as brothers, well, we invest together, even in our own building in the office, and we did a cost seg on it. Raul gets a lot sweeter deal than I do on our tax returns. He has a way lower effective rate than I do on our tax returns. But that's part of the power of being a real estate professional, though.
No, in another way, and if you're married, your spouse can be a real estate professional.
Yep,
and then since you married filing jointly, even if you have an active business or whatever it may be, you can still offset it because you're married filing jointly with your passive losses with your ordinary income.
So that's my personal setup. My wife, that is what she primarily does, is run our real estate business. She doesn't have another W-2 job. And so that is our personal setup. And we're building we close on our 10th door on Friday. So we're building a buy and hold, like long-term rental. Awesome. Thank you. And, what really resonated with me and switched me from focusing on stocks, and we'll get into stocks next because I do want to ask you guys about a couple strategies there, but I primarily had been following call it the Dave Ramsey plan, like buy index funds, mutual funds, which is a great way to build wealth, but it's different, right? On a number one, you don't have the depreciation component, right? Two, you don't have the ability to use debt and leverage as a tool, right? Which, me being a finance guy, I understand debt financing at a deep level because I've raised so much for eComm brands that, like, when a light bulb went off when I was learning this, and I was like, man, this leverage component is huge wealth building tool, right? But then the other thing is the qualified real estate professional. If you can qualify for that legitimately, and it can offset some of your active income, it has a huge tax impact. But here's what it comes down to. When I read Robert Kiyosaki's Rich Dad Poor Dad, which is what gets so many people investing in real estate, he talks about find an asset class you like. And one of the reasons is, like, let's say it's real estate, because you want to find one that, like, going and putting in the hours doesn't feel like work. You're just excited about being a real estate investor. And the more actively involved you are, the more likely you are to have the ability to potentially qualify, right? To be a qualified real estate professional. And so anyways, I've just found the other thing is too, and actually this is probably going to segue right into us talking about investing in stocks through things like solo 401ks, SEP IRAs and whatnot. But, like, the other thing I realized is, like, hey, I know there are ways to take money early out of like these retirement accounts, but when I think about, generally speaking, I got to take that money out when I'm old and I want to retire. I want to retire earlier, or I want the ability to retire earlier than that. And so
Yeah.
a light bulb went off to like real estate it's good in my mind was an easier way to pull that early retirement off than investing in these retirement accounts. But so let's segue to retirement accounts. I know there's solo 401ks, there's SEP IRAs. Anyways, who wants to hop in and like walk through the most common kind of retirement accounts you guys are advising eComm brand founders on potentially using to invest in the stock market?
Yeah, and I could take that one. It all depends on the type of business, how many employees a person has. So that's the first thing, John, that I always like to ask our clients, right? Like, hey, how many employees do you have? How many would be eligible for it? And I say that because a solo 401k, as the name already implies, it's only for a solopreneur or their spouse. So if it's just the husband and spouse, then that's good, or vice versa. So solo 401k, and same with the SEP IRA, it's good when it's smaller business, 1 to 2 people. The problem with SEP IRA, though, is if enough employees and you have many that qualify for it, you then also have to contribute for them, right? So that can get expensive too. Now, the solo 401k and SEP IRAs are the ones that have the best and highest amount that you can put into. So it is ideal when somebody has the ability to leverage those. And for the most part, those are the first two that we push them into, unless they otherwise can't from a compliance reason, right? So they have employees, because you can't discriminate and these other, financial plan issues that pop up. But once you have employees, then really a safe harbor 401k is, good for the company. Now, one thing that I explain to people is, even if you have a safe harbor 401k for the employees and yourself, you still have that 70 grand a year that you can still do through other vehicles, right? So you can still do it through an IRA. You could even do still a SEP IRA if you have self-employment income, right? Because at that point, you're not discriminating and only giving it to yourself. You've already taken care of your employees through the 401k, the safe harbor. So those are the ones that we typically see the most. Another area that I actually really like too, though, John, outside of retirement account, is SSA accounts, right? So that's pre-tax money that if you end up not having to utilize it for, it can convert into sort of a retirement account and grow as well, right? So those are the first really vehicles that we see. There is additional more advanced strategies like a defined benefit plan. Typically, high earning individuals will use that, but at the same time, that also is very similar to the other plans where you have to contribute for all the employees.
Got it.
So that one is the one that has the most, up to like almost 275,000 a year you can put into it, but it can get expensive as well if it doesn't make sense. So typically it's the solo 401k, the SEP IRA, and the safe harbors that most of our clients stick to overall.
And I know how the solo 401k works and the SEP IRA, but are all those that you went through, whatever you contribute in the current year is deductible in the current year, and then you pay taxes when you take it out later on at whatever tax rate you're at that time? Is that how those all work?
Correct. They're all pre-tax, right? So all of those vehicles reduce your taxes now until you take it out in the future. Now, the beauty of it, John, is you can actually pay it all the way to the extension time of your filing. So really, you could pay for a solo 401k, assuming, you made the calculation, or 2024 as of today, right? The deadline's not here yet for that. So you have until the next year to even contribute to some of these. So those are the few, I would say, tax strategies that are available after a year in reality, because you get a little bit more time to contribute the money.
I didn't realize you could go all the way to the extension. I thought that
For the
you could
employer
go.
portion.
Got it.
For the
Okay,
employer
for the employer
portion, not the
portion
employee.
only.
Not the employee portion, because the employee portion goes in your W-2 that has to
Got
stay
it.
within that year, right? But
Makes
the
sense.
employer portions and the profit sharing portions, you have all the way up to personal deadline extensions, actually.
Okay, I love that. That's a good tidbit. Where does cash balance plan fit into all this? I've heard about that before from someone.
So back in the day, pension plans, that's what like a lot of corporations used to have. A defined benefit plan is effectively that same kind of system. It's a little mini pension plan for your company. Now, it allows, high earning physicians, lawyers, or D2C business owners, they can put a big chunk up to, 200,000 plus into it, as long as you have a high W-2. But the problem with that program is that you also have to contribute it for a certain amount of years, and you have to commit to it because it is a pension plan. And if you break it, then the IRS taxes you on all the money that you contribute to it. So that's the risk. And you have to make sure that somebody has very good cash flow, because if you commit to it, you got to see it to the end.
You got to finish it. Got it.
Exactly.
Okay, so Raul, I've got a question for you, because you were mentioning this before I hit record. entity structure strategy. And I want to ask a very specific question because I get asked this more frequently than anything else. So we have a lot of brands that we work with that are like closely held, owned by just one founder or maybe a founder, maybe two founders, but it's not uncommon to have like a single member LLC that we work with, right? In terms of the ownership structure. And I'm finding a lot of brands who don't realize they don't know the difference between being taxed as a sole proprietor, right? And taking the S-Corp election and deciding to be taxed as an S-Corp. Can you walk through this scenario and like what the major considerations and advantages or disadvantages are?
Yeah. So, an S Corp is an LLC. It's just what the IRS is taxed as an S corporation, right? So an LLC could be a partnership, a sole proprietor, or an S Corp, right? So what an S Corp does is, let me backtrack. Everyone in the United States needs to pay Social Security and Medicare, right? Whether it's on your W-2 or at year end on your tax return, you will pay Social Security and Medicare. That's just how the system works. So what an S Corp does is basically you're going to pay yourself a reasonable salary, per the IRS wording, a reasonable salary based on your income or sales that year. On that income, you will pay Social Security and Medicare. So you actually have to go to a payroll software or go manually and do it, which I don't recommend, but you get a payroll software and actually pay yourself payroll with payroll taxes taken out that you're paying the IRS. A lot of people get that confused when they come to us. It's like, oh, well, I'll just wire money to my personal. It's like, no, you got to actually pay the IRS the taxes, right? So on that small portion, you're paying Social Security and Medicare, which then shields you from paying Social Security and Medicare on all of the income you made that year, right? And obviously
which shows up as what? Self-employment tax, right?
Exactly.
Is that what they call it? It's
self-employment tax, which is Medicare and Social Security. So that's what everyone talks about, self-employment tax, but really it's just Social Security and Medicare. Now, that is 7.65% Social Security plus the Medicare on the employee portion, but the employer has to match that. So when you're your own owner, you're a boss, and you're running your business, you have to pay that at the end of the year. So you got to make sure that that combined. So when you multiply 7.65% times 2 is 15.3%. So what people don't understand is that if you don't structure yourself this way, you're literally paying 15.3% plus whatever income tax bracket you fall in that year on an annual basis. You're just going to eat that every year if you're not structured right as an S corporation.
Well, and I don't want to get into the nuances of phase outs because I know that'll confuse people, but like, just as a simple example, right? That like, if you are an LLC taxed as a sole proprietor, right? You don't take the S Corp election. Let's say your LLC makes $250,000 of effectively that flows through to your personal tax return. We'll move to, like, put phase outs aside. You're effectively paying 15.3% on that 250K. If you instead took the S Corp election and you deemed that a reasonable salary for your position is $100,000 a year and you pay that on payroll, you pay the 15.3% on the 100,000, but you're not paying it on the other 150, right? And so it actually, if you do the math, even though which portion of it phases out at
Social Security.
Social Security phase out,
which is the bigger part of it, actually.
But that phases out at what's the amount for this year?
It changes every year.
It's around 160.
Yeah, so that phases out, but the 2% and change for
the
Medicare goes
everybody pays,
no
forever. Forever.
Yeah, so I mean, let's just say, for example, let's say your LLC tax as a sole proprietor makes $1 million, right? In like, you're going to pay that 2% forever, right? And so that's still that can add up to a lot of money. And so like it's really important to understand this. A lot of people get this wrong. And honestly, like, go set up like Gusto or some easy payroll software, ADP. I mean, literally, like, you can set it up for $50 a month and it does everything automatically. It's well worth it. Not to mention, if you're able to do so, set up a solo 401k, you can do the employee portion of it through payroll as well.
Exactly.
And then, right. And so, exactly. So like, I highly recommend, this is a tax strategy that is like very simple to set up that I see a lot of brand founders just not consider, that can save a ton of money.
Yeah. Well, I mean, the first step of tax planning is entity structuring, John, right? Because to your point, if you're already set up in the wrong end and you're just making more and more money, you're giving more and more away. And so it's important to make sure it's set up from the beginning as it should be. And typically, for the most part, S-Corp is the route for D2Cs, right? If you're an owner operator and you're working in owner, S-Corp is the route. Maybe because of the changes in code, a C-Corp, if you're somebody who's building brands and exiting them, there's a
Totally
new part of the code. Well, not a new part, it's been part of the code, but Section 1202 now is really even better because if you could grow a brand and then sell it within 3 years, 50% of your gain is exempt. If you hold it for 4
crazy.
years, 75% is exempt. If you hold it for 5 years, 100% is exempt. It is crazy. It's updated. The Section 1202 qualified small business stock has been updated because it's always been around and it's been a 5-year hold. However, it's been made much simpler now from a timeline of hold. And also it went from a company that is 50 million can now be 75 million. So as long as you're below 75 million in assets, when this exit happens, up to 10 million per shareholder of gain is exempt.
That's huge.
I mean, it's huge. It's huge, especially with people that are really, really good in the D2C space at building the brand and starting from scratch, right? You have people like that are just extremely good at it. And I think that's an area too that historically hasn't been looked at much by D2C and even small business
Totally.
owners alike. And they would qualify as long as they're buying their own product and inventory and it's their brand, they will qualify for qualified small business stock.
Yeah, as long as they're a C Corp from inception as well.
Yes, they would have to be a C Corp from inception. So that's why, the structuring of things, John, from day one, depending on the intent, right? Typically, if you're going to be running the company, S Corp all the way. If you tell me, hey, I'm trying to build this brand and exit in a couple of years, hey, we should consider that. Section 1202,
And
right?
use like outside capital. Like I think let me break
True.
this down to like conceptual. What you're basically saying is when you're thinking about entity structure, you should be thinking about who's capitalizing the business, because generally speaking, right, institutional money, they don't like S corps. C corps don't have a flow through. They don't want flow through, right? They want, and you're probably not expecting, you're expecting to take capital, capitalize the business, keep most of it in the business the whole time, right, until you exit.
Exactly.
And so you're not talking about like the S corp closely held, just extracting distributions all the time, right? That may or may not make any sense because of the double taxation. Now, so where are you getting capital from? How are you distributing capital, or are you even distributing capital as you continue to scale? And then what's the exit plan? And you got to think about all those things to make the right decision
Absolutely.
for entity structuring, right? And so it's not just one dimensional, it's multi-dimensional. Okay, so I want to ask you guys really quick here. If you could choose like the top 1 or 2 tax strategies for eComm brand founders that we haven't already talked about. We've talked about real estate and retirement plans and stuff, but like, what are some of the other top 1 or 2 strategies that are your go-to or that you oftentimes see are available to eComm brand founders?
So I would say the lowest hanging fruit, and it goes in line with what we believe as far as how you should allocate your capital, which is backing your business, is really the whole cash to accrual component under Section 471, right? So if you're below 30 million on average in revenue for the last 3 years, you're considered a small business taxpayer, believe it or not, even a $20 million, $30 million business. And you can take this election of Section 471 that basically allows you to expense your purchases and materials up front when you buy it and actually purchase the product. So what we like to have, and we've done this with some of our clients, mutual clients, John, right, is take a look at Q1 of next year. And again, we're not about buying nonsense. Look at Q1 next year, prepay for your product, prepay for marketing, prepay for insurance, right? What are things that you're going to already consume that you can now deduct in this year, being cash basis taxpayer, and reduce your taxes? So you're effectively just keeping more money in your pocket, right? For the same stuff you're going to acquire here in the next few months. So that's, to me, is the lowest hanging fruit based on the size of the DTC. Once you get past 30 million, unfortunately, that's not available. But for any brand between 0 to 30 million, that's something that they should look at and consider. The other area now that we see too is R&D. For the last couple of years, R&D was kind of messed up by the prior changes, but now it's back to being able to be expensed and get the credit immediately. Up until this year with Trump's new changes, we had to then amortize the cost over 5 years. So
Got it.
where I see it in the D2C space is if people are formulating their own brands, creating their own product, right? They have their own molds, whatever the nature of that manufacturing or production is, some of that will qualify for R&D. So it's an area that we're also talking to our clients to really understand what they're doing, right? Because R&D specific of, there's certain things that are qualified research expenses, there's certain things that are not. But you have to talk through with a client, a business owner, to really kind of dive in. And we do that during tax planning to see if there's any available, juice to squeeze out of that.
Yeah, that's a
And
huge
then the
change.
Section 1201 too.
That's a huge change because, like Rolando said, you're amortizing that. You're literally paying someone, let's call it $100,000, but you would only be able to deduct that on your tax return, a portion of that, rather than, hey, I
20.
literally just this money went out my door. It's like the opposite of
Yeah,
what we talked about
for
phantom
sure.
income with real estate. It's like
For
you're
sure.
literally having an expense that you can't fully expense that went out the door because of that amortization. So it really is a big change, and definitely something that D2C brand owners should pay attention to.
I love that. And on the cash basis tax filing too, if you are not deferring, or if you're not hanging up inventory on the balance sheet, let's just say you're carrying $1 million of inventory, you are basically recognizing all of that. Like, you're not having to defer that to the balance sheet and pay taxes
Correct.
on it for the period that you're
Correct.
holding that asset, right? Like, so I mean, that's another interesting advantage. Last question. Is what we get this all the time, and you and I we've already talked about this, offline, but like, there's this misconception out there that, like, if you're doing cash basis tax books, you have to do cash basis books for internal management. And I believe that it's because a lot of the small mom and pop shop CPA firms that are doing the bookkeeping and they're just like a tax shop. They tell their clients that because they don't want to keep two sets of books. They just want to keep like cash tax books. But like, is that allowed to keep accrual books internally and keep cash books convert them to cash for tax return purposes?
So the way that the IRS looks at it is, if you only keep accrual books internally, then no, it's not allowed. But if you keep cash basis books and can maintain them in concurrency with the tax return, you can. And to your point, John, if you want to analyze on a separate set of books, or being able to do it off the same trial balance, then you can. But the IRS does want you to keep your books at least in the same method that you're filing with. So you could do it and also keep it in an accrual manner. You can't just only keep accrual and then file tax or cash basis, right? So that's the caveat with that overall.
For sure, yeah. So we have several clients where we effectively end up keeping both because we have the ability to switch back and forth between the two, right? And so within the software that we use, I don't know how that's done in other softwares outside of QuickBooks, but like in QuickBooks, we can keep the books on a cash basis and an accrual basis simultaneously and effectively analyze them most of the time on an accrual basis. Okay, so there's a ton more that we could talk about, but we're already going over. So I gotta land the plane here, and I'm gonna ask you guys I'm gonna ask Raul. I always like to end with a fun personal question. So Raul, here we go. What's it like running a business with your brother?
It's honestly, we talk about it all the time. We get that question all the time too. I wouldn't want to be in business with someone other than a family member or my brother in this case, because I have his full trust. He has my full trust. Yeah, of course, some days you're going to, get into it, but I'd rather get into it with someone that I fully trust with my whole heart than some random person, So being in business with my brother it's definitely more rewarding than anything. I'm on top of the fact that he's my older brother, so I look up to him. So he's been my role model. Being in business with him is by far the best decision I've made, and I've been doing it since I graduated college. So I'm very grateful for that.
I grew up in a household where my parents ran a business together. So like, I come from a family business in the household. I always love it. Actually, the only other duo I've had on the show was a husband and wife combo that ran a business together.
Good for them. Good for them. That's even harder. I'll tell you that. That might be even harder.
For sure. I grew up with
harder.
I grew up with it, so like, definitely no. Rolando, where can people find more information about you guys and CFO Associates?
Yeah, so on our website, the CFOassociates.com, you can schedule a call with us. We're happy to do free consultations, especially for tax advisory services, to kind of just understand, what people are getting. And then we explain to them our method of tax planning, which is a lot more proactive and handholding through the strategies in order to actually, execute them rather than just talk about them. And so on our website, you can share our emails to John. We'll be happy to schedule a call.
Absolutely. Right now, I mean, you guys have been our go-to when people ask us for, tax advisory from a firm who understands eComm, and we're excited to keep growing our mutual client base with you guys. And yeah, I mean, we'll probably have to have you come on for round 2 because we
Yeah,
only
happy
got
to.
to like about half the stuff I wanted to talk about. But
Love to.
appreciate you guys coming on. Looking forward to continuing to work with you guys and collaborate. And yeah, appreciate you being here, man.
Oh, thank you,
Yeah,
John.
likewise, John. I
Appreciate it,
appreciate
man.
you taking the time and inviting us. And I actually have a call with your team on Wednesday regarding one of our mutual clients. So we'll keep helping each other out here.
Yep, looking forward to it. All right, guys.
Thanks so much, John.
Take it easy, John.
All
Have a
right.
good evening.
Don't forget, if you liked today's episode, please hit the subscribe button wherever you're listening and leave us a review. It helps us reach more people like you. Also, if you want more tips on scaling a profitable D2C brand, follow me, Jon Blair, on LinkedIn. And if you're interested in learning more about how Free to Grow CFO can help your brand increase profit and cash flow as you scale, check us out at freetogrowcfo.com.